There is a number that gets repeated so often in wealth media that it has stopped sounding like a warning and started sounding like folklore. 70% of family fortunes don't survive the transition to the second generation, and 90% don't make it to the third. But here's what almost nobody explains. The families who do survive aren't smarter, and they aren't luckier. They built something the other 90% never bothered to build: an institution. Not a business, not a trust. An institution designed for one purpose only: to outlive the people who created it. It's called a family office, and it is, without exaggeration, the single most important piece of financial architecture that old money has and new money almost never builds in time. This isn't hidden, it's just never taught. What a family office actually is. Let's clear up the biggest misconception first. A family office is not a bank account. It is not a fancy name for my accountant and my lawyer. A family office is a private organization, sometimes with a full staff of dozens, sometimes lean and outsourced, built to manage the total life of a family's capital across generations, across jurisdictions, and across every domain that wealth touches: investments, taxes, legal structure, philanthropy, real estate, succession, education, even conflict resolution between family members. The concept isn't new. Historians trace the modern single-family office back to the 1800s, when industrial fortunes like the Rockefellers began formalizing what had previously been handled informally by trusted stewards and estate managers. John D. Rockefeller's office, established in the 1880s, is often cited as the prototype, a private enterprise whose sole client was the family itself. What made it revolutionary wasn't the money, it was the org chart. For the first time, a family treated its wealth the way a corporation treats its operations, with dedicated staff, defined roles, reporting lines, and continuity plans that didn't depend on any single person staying alive or staying interested. That is the family office mindset in one sentence. Wealth is not a possession to be inherited. It is an institution to be run. If you're new to this channel, this is exactly the kind of mechanism we dig into every week. Not the yachts, not the watches, but the actual internal architecture that lets money survive contact with human beings for 100 years or more. Subscribe now, because the next section is where most people watching this get genuinely surprised. The difference between a single-family office and a multi-family office, and why the family office you've heard of in the news is almost never the one doing the real work. Single-family versus multi-family offices. There are two dominant models, and the split matters more than it sounds like it would. A single-family office, often abbreviated SFO, exists to serve exactly one family. It is built, staffed, and funded entirely around that family's needs, with no outside clients. This is the gold standard of privacy and control. Everyone in the building answers to one family, has signed agreements shaped around that family's specific concerns, and has no competing loyalties. The cost of running one, however, is enormous. Industry estimates commonly place the minimum viable threshold somewhere around $100 million in investable assets, with many practitioners setting the real comfort line closer to $250 million, because below that, the fixed costs of compliance, staff, and infrastructure eat too large a percentage of returns to justify the structure. A multifamily office, an MFO, serves several unrelated families under one roof, pooling resources to bring down the cost per family, while still offering many of the same services: investment oversight, tax planning, estate structuring, sometimes concierge-level services like security and travel logistics. This is where a large share of old money with fortunes in the tens of millions rather than hundreds of millions, actually operates. It looks less prestigious from the outside. It is, in practice, often more professionally run, because MFOs compete for clients and have to prove their performance the way any service business does. Here's the mechanism most people miss. The size of the fortune determines the structure, but the structure determines the survival. A family with $40 million in an MFO with disciplined governance will frequently outlast a family with $400 million and no formal structure at all, because the second family is one bad decision, one messy divorce, or one untimely death away from chaos, with nothing built to absorb the shock. The 3 pillars: organize, protect, govern. Every family office, regardless of size or model, is built around 3 functions. Understanding these 3 pillars is the key to understanding why this structure works when so many wealthy families without one fail. Pillar 1, organize. This is the operational core, consolidating scattered assets into a single coordinated view. Old money families are rarely holding their wealth in one simple account. It's spread across operating businesses, real estate holdings, private equity stakes, art and collectibles, offshore entities, and public market portfolios, often across multiple countries and currencies. Without a central organizing function, no single person, not even the family patriarch or matriarch, actually knows the full picture. The family office solves this by acting as the single source of truth. Consolidated reporting, unified accounting, coordinated tax filing across jurisdictions, and a master ledger that tracks everything the family owns, owes, and controls. This sounds mundane. It is, in practice, one of the most powerful tools in the entire architecture, because you cannot protect or govern what you cannot see clearly. Pillar 2, protect. This is the defensive layer, insulating the family's capital from the 4 forces that most reliably destroy fortunes: taxation, litigation, divorce, and mismanagement. Protection takes the form of trust structures, insurance layering, entity separation, holding different assets in different legal vehicles so that a lawsuit against one business can't reach into the family's other holdings, and increasingly cybersecurity and physical security planning as wealthy families become higher value targets for fraud and targeted crime. Pillar 3, govern. This is the piece almost no one outside old money circles ever hears about, and it's arguably the most important. Governance is the set of formal rules that determine how decisions get made, how conflicts get resolved, and how the next generation earns, not simply receives, access to the family's capital and decision-making power. Governance usually includes a family constitution, a written document, sometimes 50 pages, sometimes several hundred, that spells out the family's values, its mission for the wealth, rules for family members working in family businesses, criteria for accessing trust distributions, and processes for resolving disputes without going to court or airing conflict publicly. It also typically includes a family council, a formal body, often meeting quarterly or annually, made up of family members across generations who review the family office's performance, vote on major decisions, and mentor the next generation into eventual leadership roles. 1230 CTA number 2. This governance layer is exactly the kind of structure most people never see because it's designed to never make headlines. The entire point is quiet, boring continuity. Drop a comment telling me which pillar, organize, protect, or govern, you think is hardest to actually execute, because I read every one of them, and it shapes what we cover next. The investment committee, where the money actually gets managed. At the center of most family offices sits an investment committee, and its structure reveals something important about how old money actually thinks about risk. Unlike a typical individual investor chasing returns, a family office investment committee is usually managing toward a different goal entirely: capital preservation across a multi-generational time horizon, with growth treated as secondary to survival. This shows up in asset allocation decisions that often look conservative or even boring by Wall Street standards. Heavy weighting toward diversified real assets, private equity with long lockup periods, and fixed income, with public equities playing a smaller role than most retail investors would assume. The committee typically includes a chief investment officer, outside advisors from private banks or investment consultancies, and, critically, family members themselves, who sit on the committee not because they're the most technically skilled, but because governance principles hold that the family must remain informed participants in decisions about its own capital, not passive recipients of decisions made entirely by hired staff. This is a deliberate check against a very specific danger: professional managers who are excellent at generating returns, but who have no loyalty to the family's actual long-term mission, and who can, over decades, quietly reshape a family's capital in ways the family never intended or approved. Why this mindset differs from how most wealthy people think. Here's the part that separates institutional old money thinking from the mindset of most newly wealthy individuals, no matter how much capital they've accumulated. Most people who build a fortune think in terms of maximizing personal outcomes: the best return, the best deal, the best exit. Family office thinking asks a fundamentally different question: what decision-making structure would still produce good outcomes, even if I weren't the one making the decisions? This is a profound shift, because it means designing systems that work when the founder is no longer alive, no longer sharp, no longer interested, or simply outnumbered by heirs with different values. It means building processes that don't rely on any one person's genius, judgment, or continued good health. This is why old money families obsess over documentation, succession planning, and formal training programs for heirs. Not because they distrust their children, but because they understand a basic truth about institutions. Anything that depends entirely on one person is not actually an institution. It's a temporary arrangement wearing an institution's clothes. A composite case study: the Harrington office. To make this concrete, let's walk through a composite case study. A fictional family built from patterns common across multiple real family offices that illustrates how these three pillars work together in practice. The Harrington family made their fortune 3 generations ago in industrial manufacturing. By the time the third generation took over, the original operating business had been sold, and the family's wealth existed almost entirely as liquid and semi-liquid capital. Public equities, private equity funds, commercial real estate, and a substantial art collection. The founder's grandchildren, now the third generation, faced the exact scenario that destroys most fortunes: a large pool of capital, multiple branches of the family with different financial needs and different values, and no operating business left to give the family a shared sense of identity or purpose. What kept the Harrington fortune intact wasn't a brilliant investment call. It was the family office structure the second generation had insisted on building 15 years earlier, specifically anticipating this moment. The organizing function meant that when the family patriarch passed away, there was no scramble to locate accounts, no confusion about what was owned where. The family office already held a complete current map of every asset. The protective function meant the art collection, the real estate, and the operating investments were already held in separate legal entities, So a lawsuit against one branch's real estate venture posed zero risk to the rest of the family's capital. And the governance function meant that when two branches of the family disagreed sharply about whether to sell the art collection, the dispute went to the family council and was resolved according to a voting process the entire family had agreed to years earlier. Not through an emotionally charged confrontation at a funeral, and not through a public legal battle. The family constitution the Harringtons had drafted specifically addressed this exact scenario. Any decision to sell a legacy asset, defined explicitly in the document, required a 2/3 vote of the family council rather than unanimous consent, precisely because the founders anticipated that unanimous agreement across a large extended family would eventually become impossible to achieve. This is the mechanism in action. Governance isn't about preventing disagreement. It's about ensuring disagreement doesn't become destruction. Raising the next generation into the structure. None of this works if the next generation doesn't understand it or respect it, which is why family offices dedicate enormous resources to what's often called next-gen education, a formal, sometimes multi-year process of preparing heirs to eventually participate in governance. This typically starts young, with children given small amounts of capital to manage under supervision, learning basic financial literacy long before they'll ever touch meaningful sums. It escalates through the teenage years into direct exposure to the family's actual financial structure, sitting in on simplified family council meetings, learning what a trust is and why distributions are structured the way they are, understanding the family's philanthropic mission. By early adulthood, in the most disciplined family offices, heirs are expected to demonstrate competence, sometimes through outside work experience, sometimes through formal coursework in finance or law, sometimes through a probationary period, actually working within the family office itself, before being given full voting rights on the family council or full access to discretionary trust distributions. This isn't about withholding money out of distrust. It's a recognition that financial capital without financial literacy doesn't preserve a family. It just delays the moment the capital disappears. This entire education process, how old money actually trains heirs before they're given real power, deserves its own deep dive, and I've made one. If you found this breakdown useful, take 15 seconds right now to hit like on this video. It's the single biggest factor in whether YouTube shows this kind of long-form, research-heavy content to more people who genuinely value it. Why this structure doesn't scale down, and what does it's worth addressing directly. Almost no one watching this has $100 million and a reason to build a single-family office tomorrow. So, why does any of this matter if you're not? Because the mindset scales down even when the specific structure doesn't. You don't need a family office to apply the underlying logic of organizing, protecting, and governing your own financial life with the same discipline. Organizing at a smaller scale might mean simply consolidating your accounts into a single-tracked overview instead of scattering money across a dozen apps and institutions you never fully review. Protecting might mean appropriate insurance coverage, a will and basic estate plan that most people delay for decades, and understanding, even at modest wealth levels, how asset titling and beneficiary designations actually work, since these quiet technical details determine outcomes far more than most people realize. Governing might mean something as simple as a written family conversation, even a one-page document about what you actually want your money to do across your lifetime and beyond it, discussed with a spouse or family before a crisis forces the conversation to happen under pressure. The families who built fortunes that lasted didn't have access to some secret investment strategy unavailable to everyone else. They had discipline about structure that most people, regardless of income, never bother to build. Because building institutional thinking around your finances is unglamorous, slow, and produces no visible reward until decades later, when it turns out to have been the only thing that mattered. The 70 to 90% failure statistic isn't really a story about bad luck, reckless heirs, or economic misfortune, even though that's the popular narrative. It's a story about structure. The families on the other side of that statistic, the ones whose wealth is still standing 3, 4, 5 generations later, didn't get there by being smarter with money. They got there by refusing to treat wealth as a personal possession and choosing instead to treat it as an institution, organized, protected, and governed by rules built to outlast the people who wrote them. This isn't hidden. It's just never taught. If this video gave you a genuinely different way of thinking about what wealth actually requires to survive, subscribe to Old Money Opulence. We publish deep, research-driven breakdowns like this every week. No fluff, no lifestyle content, just the actual mechanisms. And if you want the complete structured version of everything covered in this video, plus the frameworks we didn't have time to fully unpack here, the companion resource is linked below. See you in the next one.